You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
So we're very fortunate to have an esteemed panel with us today. I'm going to let Gib, our moderator, talk about it, but before we do, I want to introduce Gib. I met Gib a number of years ago, and I kept hearing this name, Prima Capital, pop up. I was running into things and trying to compete in the marketplace, and anyway, he ate my lunch for a long time. So, but to give a little backdrop on Gib, Gib's moderating the panel today, as you can see, and his background, he was at KPMG. He was the National Managing Director of their Investment Advisory Services. He left there as an entrepreneur and then developed a firm called Prima Capital, consulting to banks, retirement plans, registered investment advisory firms. He developed cutting-edge technology, did that for several years and went through all the trials and tribulations that an entrepreneur does. I heard some stories last night that I'm not sure I could have made it through. But then he was fortunate enough and the business grew, and this big firm called Envestnet shows up and decides they want to own his firm. And he spent the last 4 years there as chairman of emeritus of the investments as well as retirement at Envestnet. He just retired from Envestnet and decided to step back into the consulting space and has a firm called Trident. He's based in Denver, Colorado. And we actually have retained Gib to help us work through some business planning and strategy. And we're just fortunate to have him with us today. One other housekeeping note, where Jonathan Schiffer is with us. Because of the weather, we had a couple of panelists that couldn't get here today on time. And so Jonathan was gracious enough to step in, and I'll let Gib make that introduction. So with that, Gib.
Great. Thanks, Jamie. Good morning, everyone. I'm Gib Watson, and I'm joined here on our panel discussion this morning, where we're going to discuss perspectives on risk management. Joining me on the panel today are Jonathan Schiffer. Jonathan is CIO for Equus, which is a $2 billion TAMP, turnkey asset management platform that essentially provides investment solutions for individual investors, and they make their platform available to advisors. Prior to that, Jonathan was also head of portfolio management for Curian Capital. As well, we have Sam Gallo, CPA, CAIA, who is Chief Investment Officer for the University System of Maryland Foundation. And Sam is responsible for the investment of over $1.2 billion of endowment and operating fund assets for the system. So to set the stage for today's conversation, I think we want to give somewhat of a real-world perspective on risk management. And when we say perspective, the perspectives vary whether you're serving the needs of individual investors or serving the needs of institutions. And from an individual perspective, really, I think you can boil down the primary risk factor that everyone is concerned about as being longevity risk. And that is the conventional wisdom in the wealth management world has been to spend less, save more, and invest wisely to accumulate an asset that can then generate the retirement income that leads to a successful retirement outcome for the remainder of your lifetime. So certainly I think in today's world, with everyone taking better care of themselves, not not drinking too much red wine with Jamie and everybody at the CIO summit in the evenings. Eating better, better health care, but everyone now has a much longer life expectancy. I read some data here where the typical American, that is the U.S. consumer that today retires at age 65, is expected to live almost an additional 30 years. So it's an incredibly long planning horizon, and then to generate the requisite retirement income is a significant challenge going forward, and is certainly one of the more significant risk factors. So with that, what we thought we would do today is address risk management not only at the asset class level, but also at the manager selection level, and then also from a portfolio construction perspective. So I'll turn it over to you guys. Let's talk a little bit about fixed income and the bond markets. Sam, what do you see as some of the big risk factors in managing fixed income as an asset class, and what goes into your thinking on manager selection?
Sure.
In the fixed income world?
Thank you, Gib. And first off, that is an interesting comment you were saying about longevity. I was over at the Milken Institute a week ago, and they were saying that they believe the advancements in life science in 12 years will be at a point where, now whether people could afford this is another thing, but within 12 years they believe they'll have the science where every year that you live you can add an additional year to what you will ultimately end up living. So really substantial increases in longevity, that much more important to make sure we get all of this right. So with regard to traditional fixed income or alternative credit-related markets, I think the one thing that we have noticed over the last several years is it does not pay at all from a risk perspective to try to time the Fed, first and foremost. It's just a futile exercise. That being said, I think we generally can all agree that rates will more than likely go up rather than down at this point, and that the Fed has a lot of tools where they might not necessarily increase rates, but they have tools that have the ability to make it feel like a rate increase, even though they didn't actually do it. For instance, as we all know, they're unwinding the balance sheet. They've just only touched the surface of flows that are coming off the balance sheet relative to, I believe the statistics I recently saw were about 50 billion has rolled off, but still another 400 billion this year, another 600 billion next year. So the floor that was placed generally on price and volatility to some degree is a real risk going into the marketplace in 2018 and 2019. So when we think about it, we're thinking about it in terms of having more active managers. We're more of a manager of manager program. We do not go out and buy bonds and try to select the credits ourselves, but we're looking for managers that are extremely active, understand their credits, understand the duration risk that's presented to them. This is a historic time in fixed income of you're seeing an inflection point where nothing has yet inflected but an incredibly flat yield curve with knowledge that it's incredibly flat and that everything could change overnight. So we're looking to our managers to understand what that reinvestment risk is going to be, understand the credit qualities of what they're doing in fixed income. And then, of course, you add in what the government's doing at the highest level with adding to the deficit, and that's impact on credit markets in general and how our managers are acting. So those are all the things that I'm not certain I answered your question what we're looking in terms of risk, but what what we're noticing across the spectrum in terms of the headwinds facing both us, our managers, markets in general, and being aware of that is probably the first point of the risk management plan. Before we get further, I want to give Jonathan a chance to talk as well.
No, I think it was an interesting point you made about the Fed and timing the Fed. You know, this is the first time in history, really, where the Fed has not been in a programmatic rate hike cycle, that it's this wait and see, this data dependent. And although they're getting more and more consistent, we had priced this in, for all intent and purposes, 3 years ago, when we had the first negative return on the ag for an annual basis. So it's not that bonds are going to go away, but as you said, you know, really timing the Fed, timing the different tools that they're going to use and how they're going to use them rather than simple rate hikes or well-telegraphed rate hikes is going to be a real challenge for the managers. I think it's interesting that we both come at this from very different perspectives. Institutional and our client base is predominantly retail, but we also employ a manager-of-managers type of style or manager style. And we're really focused on getting that duration to be a neutral perspective. What I fear most in the debt market or with some of the managers that we see in the debt market is obviously that reach for yield. We've gone way down the cap structure, and although the fundamentals remain really strong, we've historically looked at fixed income managers or debt positions as that volatility hedge or that volatility counterpart to the equity markets. But as we've continued to reach for yield and continue to push down that, particularly alternative fixed income managers are reaching more and more equity beta every day. And so we're almost duplicating our beta you know, to the equity market as we're trying to hedge some of that equity market and look for the classic 60-40 portfolio. We end up much closer to a 75-25 portfolio. And so, you know, as we're looking at the risk metrics in the future, you know, trying to be duration neutral, it's really coming down to risk. And then really in a default cycle, if we see one coming either in high yield or, you know, or low investment grade.
Mm-hmm. So then as this easy money environment is subsiding, and I think it's fair to say that the easy money policies tended to drive assets into passive index funds and ETFs. Are you implying then that you're seeing a trend toward active management as being the more favored vehicle in the market?
It's an interesting question because on the surface it would imply that active management should be where one would logically go at this point in the cycle. However, there's nothing normal about the cycle and there's nothing normal about what's going on in markets. Let's talk about a different data point before I answer that question. Most people in the room probably are aware of this statistic, but you look at the Wilshire 5000 8 years ago, and you have 8,500 companies that are in the universe. Today you look at it, and there are 3,200 companies, public companies, that are in the universe. Even with rates rising a quarter of a percent a couple times, we're still, if you take a step back, at one of the lowest points of interest rate policy in history. So it is a very good environment for M&A, which means further consolidation of publicly traded companies. We're noticing that companies that are private are staying private for longer with no interest of going to the traditional IPO. Even with Spotify, what we saw a couple weeks ago with a very untraditional way of tapping into capital markets through a limited IPO process. And then the wild card, which has never really existed in the history of mankind, and that is the rise of the family office, where if you look 20 years ago, there were a couple hundred very, very wealthy individuals of triple-digit millions and several billions. Today, about 1,800 billionaires exist in the world, and many more triple-digit millionaires that exist in the world. So What this means for capital markets is if you're a business that traditionally would have gone IPO and into public markets, you're now asking yourself, well, should I do that? Is that the best course of action for my business? There's increased regulation. There's more scrutiny I have to do. I could go to a new family office, which has cropped up. It's a little bit more flexible capital. They're more understanding. I don't have to talk about what I'm doing in the large public markets, and I have a lot more flexibility. So I think what you're seeing is a shrinking pool of securities in public traditional markets. So to go back to your question and say, is this the time to be active? On the surface, absolutely, it's the time to be active. However, understand that you're being active in a smaller universe, which is most likely to get even smaller as time goes on, making it just that much more difficult and that much more difficult to find that alpha. And at the same time, seeing a lot of, what's the word I'm looking for? Overlap. A lot of overlap between manager portfolios. I mean, I saw a little bit of this when I started at Maryland in 2012. I remember my first week on the job, I went and visited all my equity long-short managers and asked them all the same question right at the start. What do you love? What's the best thing in your portfolio that you own? And talk to me about why. And the first manager said, Apple. I love Apple. I love Apple because X, Y, and Z. There's no better business in the world. It was compelling, so I rode the elevator up and down the building, walked across the hall, asked the same question of 14 managers, and I walked out of there thinking, my gosh, I own Apple 14 times over. This is a very levered Apple position. And that was 2012 when there were more companies. Today, when I look at my top 5, top 10, top 20 lists of my managers, yes, managers are doing a great job of trying to find that dispersion, but is it dispersion when they're all in the exact same things? Which leads me to answer, on the surface, I would answer the question, yes, active is great, but then if you ask these deeper underlying questions, is it so great? I don't know. I think we're going to find out in time. But I do think the earlier speaker today, Meb, who talked about the fees, had a really substantial point of fees eat a lot of returns. So you better make sure that you're with people who are if you are seeking out alpha, you're looking at that alpha relative to fee and making sure you get the best bang for the buck.
Right. Jonathan, anything to add on the old active-passive debate?
No, on the active-passive debate, I'm not allowed to add, but I'm certainly to debate, the new cycle that we're moving into with the Fed. As much as we're taking some of that liquidity off the table, it's a long run. So if we're trying to make the bet or the change to an active manager at this point, we may be premature. The rising tide raises all boats, and just because it's settled now, we're far from a tightening cycle. I would say that we have some time there. We'd start looking and evaluating the active managers, being prepared for that, and as further, looking into the PE space, the private equity space, to really reiterate his thoughts there. But we've seen Norfolk Southern a couple years ago. We've seen Mexico issue their 100-year bonds. These companies and these foundations and sovereigns are really getting their weighted average cost of capital kind of situated and being prepared for that next cycle there. So I do think that in that regard, coming full circle, yeah, that active managers should be able to pick that out a little bit better, to really be looking at the cost of the equity of these sovereigns, of these individual companies, and be able to pick them, particularly in an environment where we might be seeing, low 7% or all the way down to 3%. On a historical basis, 1% of excess return will be much more meaningful than it will be at the level of one guy got 22 and one guy got 21. It's going to be a little more impactful and really affect your actuaries.
Mm-hmm. Mm-hmm. Yeah, I think Sam touched on a really good point here in terms of knowing the securities or the holdings that an active manager is managing in their portfolio, and it addresses the importance of conducting holdings-based analytics as well as returns-based analytics on the managers that you decide to implement your different asset class strategies in a client's portfolio. One of the approaches that we took with our technology Prima Guide was that we would collect all of our data directly from the asset managers, and then we would plot the portfolio holdings at specific points in time on a biometric profile. That is, we'd plot security characteristics on the horizontal axis versus market cap on the vertical axis, and then you'd see a scattergram as to how the holdings in the portfolio manager's portfolio were actually displayed. And then when you would superimpose multiple managers who are allegedly small cap value versus mid cap versus large cap growth, you can really see their adherence to their investment mandate, whether there's any drift and overlap in the portfolio, and whether you're inadvertently stacking securities into a particular quadrant of the famous Morningstar style box, right? So it's interesting. So we're kind of moving into the world of equities. So let's talk a little bit about risk management for equities, domestic, international, emerging markets. What do you see as some of the risk factors, and how are you guys managing those factors?
I was at an event. I'm on the MFA board, and I was at their event in January, if any of you were there as well, where Nassim Taleb, who wrote the book Black Swan, addressed the crowd. Many of us, I imagine, have read the book, but it's essentially talking about these outlier events that occur and essentially blow up your portfolio, if not managed appropriately. So he was talking about, he was first trying to get to the definition of what is risk in talking about equity markets, and I thought it was actually very profound what he said. He said, the investment industry does not understand the word risk. They actually use the wrong word. Risk is the probability of taking a zero mark, a pure annihilation, complete loss of capital, nothing, no more. He said, that's risk. He said, everything else is just noise. So Buffett hit on a negative 50% 4 times in his 50, 60-year career. And he would probably say that wasn't risk, that was noise, in almost similar fashion to what Taleb was talking about. And he said if you could first define risk as a 100% wipeout of capital, and then answer the question of how am I not going to have that happen to me, then you could start constructing your portfolio, because then you know you're really not taking risk, you're accepting noise. And I thought that was profoundly different than talking about risk as a negative 10% in the market in February, or a negative 20% or 30% event, because a lot of people who see it as noise use that as usually rebalancing impacts. I know a Swan strategy, and not to plug Swan, but we are investors and we're believers in what they do. But I think they highlight it, because I was thinking of Swan as Taleb was talking about this. It was the idea of first know that you can't have 100% wipeout of capital by one of the legs of their strategy, and then everything else you're managing around that. And when I think about our portfolio and how we manage risk, that's absolutely how we think of the world. Now, that said, do our investment committees, do our board, do others around us, do our peers, do they look at the one-year performance? Of course, everybody looks at the one-year performance. Is everyone a little short-sighted in terms of what they're looking at relative to the longer-term picture? Absolutely. I think that's just, unfortunately, that's a human bias that doesn't matter if you're at Maryland or you're in Minnesota or Indiana or wherever. But we're looking at risk from the construct of first asset allocation. And we get that diversification is only going to help you so much in a crisis, but do you have a mix of assets that generally move at different velocities, that move at different speeds? Do you have a mix of managers who've put on positions that have, maybe they've answered the Nassim Taleb question of, have I eliminated the probability of annihilation to zero? And then what am I going to do around that? And then looking at everything else as noise that could be positive noise. Using that noise as an opportunity to take advantage of things, whether that be through insurance risk premium, being at a heightened state, or at a low price of something you love that you just get to buy more of. But not looking at it as a panic state of, oh my gosh, I just lost 50% of the portfolio, because that's very much a short-term focused way of looking at investing. And I do believe the long-term viewpoint, and probably looking at risk as probability of annihilation, and anything else is noise, I think that probably gets you to a safer spot in risk management.
Yeah, I think that's a pretty interesting approach to that. With our retail base, our definition of risk changes a little bit. It's not only risk of the portfolio, but it's also risk of participation. When you look at a portfolio from an ivory tower aspect and say, what's the probability of zero? Well, probability of an 80% drawdown, 70%, 60% drawdown to our client base is just as impactful as a zero.
Yeah, that feels like zero.
Exactly. Sometimes it feels worse than zero. So it's that participation risk which is just as important to us. And so we're looking at historical volatilities. And as much as we'd like to project volatility into the next year and understand what the vol target would be for our portfolios, in reality, it becomes an observed characteristic. And so it's what are we doing to the portfolio based on that observed characteristic of volatility for the next step? How are we reacting to that volatility? If we're getting outsized volatility, the equity markets have been more volatile lately, but extremely benign. And the bond market is at a precipice of seeing more volatility. So how do we express that to our client base or to the portfolios in a way that we can continue to participate on the upside? Because the risk of not participating on a 20% upside is just as detrimental as taking a 50% drawdown to us. And so we have to manage both of those characteristics and make certain that the portfolios are returning something, albeit 3%, 7%, or if we're millennials, 25%. We just have to balance those expectations and build a portfolio for longer periods of time. Just because our end client is a retail investor with an 18-month horizon, our advisors tend to have a little bit longer projection on that. And the only way to really apply science or mathematics is to look at a longer time horizon. And so it is interesting. I think risk is one of these words that our industry throws around almost as loosely as alpha. What is the definition of alpha? What is the definition of risk? Ask 10 people in the room and they're going to give you 10 different answers.
You bring up a really interesting point of, we spend a lot of time talking about left tail risk, but there is such a thing as right tail risk as well. The risk of not being exposed and missing out on one of those amazing opportunities that they just don't happen all that often. And I remember reading, I might get the title of the book wrong, but it was something I read when I was getting my MBA at University of Chicago, but it was something to the extent of why smart people make stupid money mistakes. And it was a really good analysis where they looked at 10,000 trading days, which is the equivalent of 40 years of trading. And how many days actually matter in 40 years? And what this study basically said is 11 days mattered. That was it. Everything else was noise. That if you happen to have just bought at the open on each of those 11 days and sold at the close and forgot about everything else, if it were only so easy, right? The impact on a portfolio from a compounding standpoint is enormous. So they looked at the Harvard Endowment and looked at some asset allocation decisions they made in the 1980s where they decided to reduce their equity exposure in a year where 3 of those days out of 11 occurred. So, and they didn't reduce equity all that much. I mean, we're talking about going maybe from a 36 to a 32, but what was the impact on the endowment? And they were able to look at this into modern day, like 2000, I think the book was written like 2015, 2016. And Harvard today, no doubt, is a very large plan. If I get the number wrong, excuse me, but it's probably around 40 billion today, I would estimate. But when the study was done, they were roughly about 31 billion. And the study basically said they'd be a $144 billion plan today by not taking that upside risk. So I think failure to have exposure is almost as bad as failure to have too much exposure, be levered, and not have a smart-oriented portfolio to deal with downside. Mm-hmm. Both tails matter.
Yeah, yeah. So I thought Meb did a great job this morning in addressing the fully valued nature of equity markets, mm-hmm. As well as fixed income markets. We have a number of risk factors that we're facing in terms of we're in a rising interest rate environment, full valuations domestically, internationally on the equity scene. And I think it's also fair to say that we have a fair number of geopolitical risk factors, potential trade wars that could impact the GDP here in the U.S., could impact corporate earnings, certainly. So it's also been said that the starting point matters, right? So our business is all about generating returns and protecting against downside loss. So how are you entering the equity markets for new investment dollars, and how are you going about really mitigating some of these risks for your investors?
Well, I first think that again, always things on the surface look one way, but you got to look a little deeper. On the surface, things do appear richly valued, but at the same time, whether you believe these things work or not, I think BlackRock did a really interesting matrix a while back where they showed U.S. Treasury yields across the x-axis and earnings per share of S&P 500 on the y-axis, and then inside the matrix are all the values of the S&P, just using a dividend growth, like the Gordon dividend growth model. And if you were to do that at a 3% 10-year and roughly 151 to 52 EPS on the S&P 500, one could almost argue we're exactly rightly valued today based off dividend discount model. If you look at standard deviations relative to 20-year average, we're really not even at the 1-year standard deviation of PE. Now, CAPE would tell you that we're completely overvalued. So I think you got to be careful in what you're looking at. Now, granted, I think it is expensive personally. So how are we thinking about equity allocations going into the future? Well, we think the U.S. had a really great run, and we are definitely probably as guilty as others of home country bias to an extent. And so many plans, I believe, us included, are relatively underweight some international and emerging markets. Not because we don't like them, but because it's not as comfortable feeling and sounding when you talk with the committees or the clients. There's a different, to some degree, legal structure and process that you have to deal with, and just a different era of governance depending on the region that you're looking at, and corporate governance could be very, very different, and we know that it has a massive impact, I believe, on valuations. So as we look forward, we're probably looking to address our home country bias a bit over the next year or two. I'm not saying we'll change it, but we're definitely looking at it, and we're looking at the emerging markets in more detail today than in days past, because we take the valuation piece out. I think us and many of my peers are very underweight emerging market exposure. I wouldn't be surprised if others are as well in the crowd for many of the reasons I listed. If you're exactly where you want to be at target or overweight, kudos. I think that's a hard thing to do when you're operating in a governance structure of many different minds working together to build these portfolios.
Yeah. So Jonathan, let's shift gears a little bit and let's talk a little bit about alternative investments. How are you using alternative investments on the Equus platform? How are you helping advisors with portfolio construction? That is, are you using alternatives more as equity replacements, equity enhancements, fixed income replacements, fixed income enhancements, or as general portfolio diversifiers?
Yeah, we're looking to actually increase our use of alternatives within the platforms. And if you believe this bull market has gone on for 10 years and will eventually end, I think you have to believe that alts would come back into favor. We basically look at equity hedge, debt hedge, global macro, and event-driven as the 4 primary categories of our alt exposure. And within the debt, obviously, we've talked a lot about bonds and, bond alternatives. So I certainly think some debt hedge can be a value add within the fixed income allocations. The equity hedge, talking about the valuations, I think we're on the expensive side of average. If you just take however long, pick your broad index, and you look at the forward 1-year operating earnings and do a standard normal distribution on that, we're on the expensive side of average. So 70% of the time, the market kind of seems expensive. And so you want to look at some equity hedge, and again, for that tail risk, that drawdown protection, I think you can see some spaces there. But I would really be focusing on the event-driven and the global macro. Those are going to be, the event-driven, obviously, you're least correlated, but your global macro is going to be able to move with those trends. They're going to be able to, use futures, so you'll be inherently long VIX, inherently a little protective against the equity beta that you see in the market, and they'll be able to flop positions. So yeah, obviously, it's a huge amount of risk as sponsors, putting that much autonomy into a manager. But if you really understand their approach and understand what they're doing, and you can have some good history on that, applying that into the portfolio eliminates a huge amount of fund risk.
And then Sam, any thoughts on adding real estate, private equity, venture capital in that alternatives bucket?
We have quite a bit of all the above in that bucket. The private investments.
That's why I asked that question.
Yes, the private investments are immensely interesting. What people are working on. The issue is the valuation. I was talking with some folks of a top 5 private equity fund the other week. Their founder, and he was telling me how just the purchase price multiples are just ridiculous on some of these deals. We've heard people paying 14 times EBITDA and just being absolutely okay with it. And that's a really high number. You usually want to be buying these businesses in normal times at, if you can, a 5 to 7 multiple on EBITDA. So, you make your money more on the buy than you do on the sell. I've heard many instances in private markets where you could buy the absolute worst company at the right price, do all the wrong things, and walk away from it with so much return if you bought it right at a low multiple. But yet you could buy the perfect business, absolutely ideal, perfect, everything is spot on. But if you pay a 14 times EBITDA, there's no way you're getting out of that thing unharmed on average if you do it time and time and time again. So I was asking the question, what are you doing these days? Are you getting into smaller oriented deals where it's more niche-y? And expecting, I was throwing the guy a softball, I was expecting him to throw it right back. And he said, absolutely not. He said, that's not what we're doing. If anything, we have to go larger, bigger, badder, more complicated, harder to get out of. It's going to take years. Like if you were expecting your money back on these deals a couple of years ago thinking you get it back in 6 to 8 years, now we're telling you 12 to 15. because that's the only way we could buy this stuff at 5 to 7 time multiples. Is they have to be things that no one on the planet could write a check for, and no one on the planet understands how to do it. That's how complicated it is. So that doesn't necessarily make me feel that much better. Quite on the inside, gee, you're going to take my money for longer and make it more complicated for me to understand. But at least you'll buy it right. So we like the private markets, but the issue is there too much capital there? We've heard the $1 trillion plus of dry powder that exists. That funds are coming to market like that. I mean, the minute we see a fund close, they're coming right back a couple months later asking us for money again for their next fund. I worry about the lack of discipline in the industry, that people are overpaying for whether it be real estate or private equity related deals. But yeah, we are very heavy into it. That being said, the thing I worry most about in that type of environment, when the fundraisers go like that, when the deals are just mega, nobody concedes on fees. You're paying top dollar on everything in richly valued markets. It's usually not a recipe for longer term success. So I really I'm quite worried about the private markets these days. They actually, to some degree, and depending on what metric and what data source you look at, they might actually be more expensive than public markets, just because there's that much competition going on inside of it.
Mm-hmm. You know, it's interesting when we're talking about perspectives of risk management, and particularly how those perspectives relate to public pension plans. I think one of the big risk factors that a number of public pension plans are facing is this risk of unfunded or underfunded pension liabilities at the end of the day, and then what that can do to our economy and our social structure here in the U.S. I think back in the day when I used to do some institutional consulting, the favorite formula for looking at a pension plan, particularly a public pension plan, was to focus on C plus I equals B plus E. That is contributions to the plan plus the investment return that you're earning on the plan equals the benefits that are paid to the plan's beneficiaries plus expenses. And from a practical perspective, the CIO on that plan can really control that investment return and the expenses that are incurred in managing that plan. So I think it's, you know, it's useful to think about, you know, how can we simultaneously increase returns at a reasonable cost while mitigating the cost of friction and the risks of friction in the equation while we're managing through. Any thoughts on from what you've seen in the public pension plan world as to how we might be able to bring that equation into better balance?
I think I'm going to let Jonathan go first.
Sure.
Do you have public pension clients, or I used to be a public pension consultant.
Not a lot, but
so
I did in the
speak to
past.
that.
Yeah.
But go ahead. Why don't you go
No, I
first, and then
think, you know,
I'll add
looking
in.
at the actuarial rates, you know, we're largely unfunded in a lot of situations. We're looking at, you know, 10, 11% actuarial rates or hurdle rates. You know, that's only going to exacerbate the underfunded dilemma that we see out there. You know, taking a look at the managers, doing a deep dive if you're using a manager approach, doing a deep dive and understand what these managers are doing and how they're approaching the markets so that we can eliminate some of those frictional costs of manager turnover. Again, there was another slide on that earlier this morning. Looking at these managers, understand what they're going to do and be very intentional about your asset allocation. Let's not look at an overlap afterwards and say, oh my gosh, we're overexposed. Be very intentional in finding the manager that's going to apply that active approach into a specific beta that you're looking to add to the portfolio so that we can approach that in the best way possible. And again, really the actuarial rates, understanding what those are, what that can affect to the economy. Fortunately, I think most of these companies are in a fundamental good place, so on a DB plan that they have the ability to continue to fund some of these DBs, but in the DC world, it's a very different story if we don't get our actuarials right and do end up living to 95 to 100 years old.
I would add to that by saying, first, address realistic expectations and objectives. It sounds easy, but it's so hard. I know we're going through this in real time right now. We have an investment committee meeting in a few days, and we're looking at our IPS. And one of the points of that IPS is a return objective. And some people on the administrative side feel, well, why can't you just put in a number that says spending plus inflation plus fees, and let's use real sounds good, so let's just say you're going to get a real return of 6%, inflation and then fees. And I said, you do realize you just told me to make 10% annualized for the remainder of time, right? And they're like, yeah, is that a problem? and that's talking about unrealistic expectations. I'm having this discussion in real time where I'm saying maybe it's not about us telling the market what to do. Maybe it's about us saying, okay, market, this is what you're providing, so we're going to adapt to you. And I think it's just a more intelligent way of dealing with it, with the problem. So first, get realistic expectations. I know investment teams are doing their parts. We are selecting product that's cost effective relative to what we're seeking. But then there's the spending side of things. And sometimes that's not an investment team's issue, but becomes our problem of talking to our clients, whether they be individuals, pensions, or endowments, of, are you spending too much? Why is it that the spend rate has been constant through time, regardless of what markets do? I think you have to look at that. And third, I think you have to look at time horizon. Looking at anything on a 1-year basis, 2-year or 3-year, is just so short-sighted. You're just not, you're setting yourself up for disappointment on day one. Looking at something, I even think to some degree, depending on the types of investments you're in, we're in private equity, real estate, natural resources, and infrastructure. That by itself means our evaluation period probably should be a decade. Will I ever get my committee to say, pay me on a decade basis? What I do 10 years from now, evaluate it then? No, they want to look at what I did during the current year. So I think that's where the governance kind of breaks down with what you should be doing. But to the extent any of you have clients or the opportunity to encourage longer time frames with realistic numbers, with spend rates that are more aligned with the ebbs and flows of markets, I think those are all really positive moves in the right direction to get to where you need to be. But the wrong move is probably what we've always done of, okay, we need to earn X, investment team, go find it. Reach for yield, take leverage, do whatever you need to do, just go get it.
Risk.
We're going to spend this amount, we're going to make it static and fixed, and that's just how it's going to be. And
sounds a lot like the U.S. budget.
Yeah, it does, and
Save more, spend more.
Exactly, and then you got the wild card that everybody can't expect, and that's inflation. It depends what your measure of inflation is. Our measure, we cannot use the measure we'd like to use, which is higher education price index, because that's a crazy number of inflation. I have one wish for everyone in the office, in the audience today. May you only ever be paid by the higher education price index as your COLA. You'd be pretty wealthy.
And on that note, I think we're about out of time here for our panel discussion this morning. Thank you, everyone.
Or is there a Q&A, or we're out of time?
We're pretty much out of time, and apologize for running over a little bit here on the agenda. So thanks, everyone.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.